Right now, major banks can't sell silver the way they used to. Not because of regulations, not because of shortages, but because something fundamental broke in the system. This exact pattern destroyed the Roman Empire's currency, triggered Weimar Germany's hyperinflation, and today it's happening again. But this time, almost nobody's watching. By the end of this video, you'll understand why silver might be the most important asset nobody's talking about. And why history says you should pay attention right now. Here's what's happening behind closed doors. In 2024, institutional restrictions are quietly reshaping how banks interact with physical silver. Not through headlines or press releases, but through subtle market mechanics that most investors completely miss. The paper silver market, futures contracts, ETFs, unallocated accounts, is roughly 250 times larger than actual physical silver available for delivery. Think about that. For every real ounce of silver in a vault, there are 250 paper claims saying I own that silver. And when banks face restrictions on selling physical silver, that ratio becomes a powder keg. But before we dive deeper into what's happening today, I need you to understand something critical. This isn't new. This isn't unprecedented. In fact, this exact scenario has played out multiple times throughout human history. And every single time, the outcome followed a predictable pattern. So let me take you on a journey through time, because understanding the past is the only way to see what's coming next. Let's start in ancient Rome, 211 BC to be exact. The Roman Republic introduces a new silver coin called the denarius. This wasn't just any coin, it was roughly 95% pure silver, weighing about 4 or 5 grams. It became the standard currency across the entire Roman world. Soldiers were paid in denarii, taxes were collected in denarii, trade across the Mediterranean was conducted in denarii. For the average Roman citizen, this coin represented trust, value, and stability. But here's where the story gets interesting, and frankly, a bit predictable if you know human nature. The Roman government needed money. Wars weren't cheap. The expansion of the empire required massive military expenditures. Infrastructure projects, roads, aqueducts, public buildings, they all cost money. Political campaigns and bribes to secure power, more money. So what did they do? They started reducing the silver content in the denarius while keeping the face value the same. At first, it was subtle, maybe 90% silver instead of 95%. Most people didn't notice. The coins looked the same, felt the same, spent the same. But over decades and centuries, this debasement accelerated. By the time Emperor Nero came to power in 54 AD, the denarius was down to about 80% silver. By the reign of Marcus Aurelius in the late 2nd century, it had dropped to around 75%. Then came the 3rd century crisis. Emperor after emperor, trying to fund their armies and maintain power, kept debasing the currency further. By 270 AD, under Emperor Aurelian, the denarius contained less than 5% silver. It was basically a copper coin with a thin silver wash. What happened to the Roman economy during this time? Exactly what you'd expect. Inflation skyrocketed. A measure of wheat that cost half a denarius in the 1st century cost hundreds of denarii by the 3rd century. People lost faith in the currency. Barter became more common than monetary transactions. Soldiers demanded payment in goods rather than coins. The empire's tax system broke down because the currency was worthless. And while this wasn't the only reason Rome fell, it was absolutely a contributing factor. The destruction of their monetary system through currency debasement weakened the empire from within. Now, you might be thinking, okay, that's ancient history. We're more sophisticated now. We have central banks, monetary policy, economic theories. We wouldn't make the same mistakes. Well, let me introduce you to Weimar Germany. After World War I, Germany was devastated. The Treaty of Versailles imposed crushing war reparations. The government owed enormous sums to the victorious Allied powers, and they had to pay in gold or foreign currency, not German marks. The problem: Germany's economy was shattered. Production was down. The workforce was depleted. Tax revenues couldn't cover the government's obligations. So what did they do? They printed money. Lots of it at first. In 1919 and 1920, the inflation was manageable. Prices rose, but not catastrophically. But then it accelerated. By 1921, the exchange rate was about 60 marks to $1 US. By 1922, it was 7,000 marks to the dollar. And then 1923 hit and things went completely insane. By November 1923, $1 US equaled 2 trillion marks. Let me repeat that. 2 trillion marks for a single dollar. The human stories from this period are almost unbelievable. Workers were paid twice a day because the money lost value by the hour. They'd rush out during lunch break to spend their morning wages before prices rose in the afternoon. People carried money in wheelbarrows, literally. There's a famous story of a woman who left her wheelbarrow full of cash outside a store for just a minute. When she came back, the money was dumped in the street, and the wheelbarrow had been stolen. The wheelbarrow was worth more than the millions of marks it contained. Bread that cost 250 marks in January 1923 cost 200 billion marks by November. A postage stamp went from a few marks to 50 billion marks. Life savings were wiped out overnight. The middle class was destroyed. People burned paper money in their stoves because it was cheaper than buying firewood. But here's the critical part. Those who held physical assets, gold, silver, real estate, foreign currency, they survived. Some even prospered. The paper mark was worthless, but an ounce of silver was still an ounce of silver. It held its value across the chaos. The Weimar hyperinflation eventually ended in late 1923, when Germany introduced a new currency backed by real assets and restructured their debt. But the social and political damage was done. The destruction of the middle class, the loss of faith in institutions, the economic desperation, all of this contributed to the political instability that would eventually lead to the rise of extremism and the horrors that followed. Now, I'm not saying we're heading for Weimar-style hyperinflation tomorrow, but here's what I am saying. The pattern is always the same. Governments or monetary authorities expand the money supply beyond what the real economy can support. They do this for various reasons: war, debt, political pressure, economic stimulus. At first, the effects are subtle, but over time, trust in the paper currency erodes. People start looking for alternatives, and throughout history, they've consistently turned to tangible assets, especially precious metals like gold and silver. Let me give you another historical example that's often overlooked but incredibly relevant. In the 16th and 17th centuries, Spain controlled massive silver mines in the New World, particularly in Potosi, in what's now Bolivia. Spanish galleons carried tons of silver across the Atlantic to Spain, and then throughout Europe. This influx of silver was supposed to make Spain wealthy and powerful, and initially it did, but something unexpected happened. As more and more silver flooded into Europe, prices began to rise. Economists call this the price revolution. Between 1500 and 1650, prices across Europe increased by 300 to 400%. Why? Because the money supply, in this case silver, was growing faster than the production of goods and services. This is a fundamental economic principle. When you increase the money supply without a corresponding increase in real economic output, you get inflation. But here's what's fascinating. Even though Spain controlled the silver mines, Spanish power actually declined during this period. Why? Because the inflation destroyed the purchasing power of their currency. The massive influx of silver undermined the value of silver itself in European markets. Spain became dependent on imported goods, which became increasingly expensive. The real wealth flowed to the merchant classes and manufacturing centers in other parts of Europe, while Spain, despite its silver, fell into economic decline. The lesson here is nuanced but important. It's not just about having gold or silver. It's about the relationship between the money supply, real economic production, and trust in the monetary system. When these get out of balance, instability follows. Now let's fast forward to the 20th century and look at the United States. In 1792, the Coinage Act established the US dollar on a bimetallic standard, meaning it was backed by both gold and silver. Silver coins were used for everyday transactions. The relationship between gold and silver was fixed by law at a ratio of 15:1, meaning 15 ounces of silver equaled 1 ounce of gold in value. Throughout the 1800s, major silver discoveries, like the Comstock lode in Nevada in 1859, affected this balance. More silver meant silver became relatively cheaper compared to gold. This created political and economic tensions that lasted for decades. You had the free silver movement in the 1890s, with William Jennings Bryan's famous Cross of Gold speech, where farmers and debtors wanted more silver in circulation to create inflation and ease their debt burdens. But the key point is this. For most of American history, silver was money. Real, tangible, spendable money that started changing in the 20th century. In 1933, President Franklin Roosevelt took the U.S. off the gold standard domestically and ordered citizens to turn in their gold. In 1965, the U.S. stopped minting silver coins for general circulation. The quarters and dimes you use today are copper, nickel alloy, not silver. In 1971, President Nixon ended the Bretton Woods system, completely severing the dollar's connection to gold. Since 1971, the US dollar, and indeed most world currencies, have been purely fiat currencies. They have value only because the government says they do, and because people trust them. There's no gold or silver backing them anymore. Now, fiat currency isn't inherently bad. It gives governments and central banks flexibility to manage the economy, but it also removes the natural constraint that physical backing provides. With a gold or silver-backed currency, you can't print more money than you have metal. With fiat currency, the only limits are political will and economic consequences. And here's where we get to the heart of the current situation. Since 1971, and especially since 2008, the money supply has expanded dramatically. After the 2008 financial crisis, central banks around the world implemented quantitative easing, essentially creating money electronically to buy bonds and other assets. During the COVID pandemic in 2020 and 2021, money creation went into overdrive. The US money supply increased by roughly 40% in just 2 years. That's unprecedented in peacetime. What's been the result? Inflation. Not Weimar level hyperinflation, but significant inflation nonetheless. In 2021 and 2022, inflation rates in the US hit levels not seen since the 1980s, peaking at around 9% year over year. Prices for food, energy, housing, everything increased substantially. And while inflation has moderated since then, prices haven't come back down. They've just stopped rising as fast. Now, let's connect this back to silver. During periods of monetary expansion and inflation throughout history, people have turned to tangible assets. Gold and silver have been the go-to stores of value for thousands of years because they can't be printed or created at will. You have to mine silver out of the ground. It requires real work, real resources, real energy. An ounce of silver is an ounce of silver, whether it's 2024 or 224 BC. But here's where the modern silver market gets really interesting and really complicated. Today, silver exists in two parallel markets that are increasingly disconnected. There's the physical market and the paper market. The physical market is straightforward. It's actual silver, coins, bars, bullion that you can hold in your hand. Global silver mining produces about 25,000 metric tons per year. To put that in perspective, that's roughly 800 million ounces. But here's the catch. About 60% of that, roughly 80 million ounces, goes to industrial uses. Silver is used in electronics because it's the best conductor of electricity. It's used in solar panels, in medical applications, in batteries, in water purification, in photography, even though that's declined with digital cameras. Industrial demand for silver isn't optional or speculative. It's necessary. Companies need silver to manufacture products. That leaves about 320 million ounces for investment in jewelry. Some of that goes into coins and bars that investors buy. Some goes into jewelry, particularly in countries like India, and some goes into what's called above-ground stocks, silver sitting in vaults and warehouses. Now, recycling does add some supply back into the market. Old electronics, jewelry, and industrial scrap can be refined to recover silver, but recycling only adds about 180 million ounces per year, so total physical silver supply from mining plus recycling is roughly 980 million ounces annually, with about 60% of that immediately consumed by industry. Now let's talk about the paper market. This is where things get wild. The paper-silver market consists of futures contracts, exchange-traded funds, unallocated accounts, and various derivatives. The largest venue for silver trading is the COMEX, which is part of the CME Group in New York. On COMEX, traders buy and sell silver futures contracts. Each contract represents 5,000 ounces of silver. Here's the thing. Most futures contracts are never physically delivered. Traders buy and sell contracts, profiting or losing based on price movements, and then close out their positions before delivery. It's estimated that less than 1% of COMEX futures contracts result in actual physical delivery of silver. The vast majority are cash settled or rolled over into new contracts. This creates enormous leverage. A single ounce of physical silver might have dozens or even hundreds of paper claims against it through various futures, options, ETFs, and bank accounts. Different analysts estimate the paper to physical ratio differently, but credible estimates range from 100 to 1 all the way up to 250 to 1. That means for every ounce of silver actually available in a vault, there might be 100 to 250 paper claims saying I own that silver or I have the right to that silver. Now, in normal times, this system works fine. It provides liquidity. It allows hedging. Miners can sell forward production. Industrial users can lock in prices. Speculators can trade. The market functions smoothly because everyone understands the game. Most paper claims will never demand physical delivery. But what happens when that assumption breaks down? What happens when a significant number of paper-silver holders say, I want the actual metal? That's when you get what's called a delivery squeeze, or a short squeeze. We saw hints of this in early 2020 and again in 2021 during the Wall Street Bet silver squeeze attempt. In March 2020, as the COVID pandemic hit, demand for physical silver coins and bars skyrocketed. People wanted tangible assets amid the uncertainty. But the paper price of silver on COMEX actually dropped initially, falling below 12 per ounce. Meanwhile, if you tried to buy a physical silver coin, you couldn't find one for less than 20 or 25. Some dealers were completely sold out. The premiums, the amount above the spot price that you pay for physical metal, spiked to 8 to 10 per ounce. Think about that disconnect. COMEX said silver is worth 12, but you literally could not buy a 1-ounce silver coin for less than 20. That's a 67% premium. That's not a small discrepancy. That's a different market operating on different principles. The paper market said one thing. The physical market said something completely different. This happened again in early 2021 when retail investors, inspired by the GameStop short squeeze, tried to squeeze silver. They bought physical silver and shares of the silver ETF SLV, trying to force delivery and expose the paper leverage. The movement didn't fully succeed in breaking the market, but it did cause significant strain. Premiums spiked again. Some dealers had delays of weeks or months for delivery. The disconnect between paper and physical prices widened. Now here's where bank restrictions come into play. Banks and financial institutions are major players in the silver market, both physical and paper. They hold silver in vaults for various clients. They trade futures and options. They provide liquidity to the market. But increasingly, there are regulatory and internal restrictions on how banks can interact with the physical commodity markets. After the 2008 financial crisis, regulations like the Dodd-Frank Act in the US and Basel III internationally imposed stricter capital requirements on banks. Holding or trading physical commodities requires more capital to be set aside. This makes it less profitable and more risky from a regulatory standpoint. As a result, many major banks have scaled back their commodities operations. JP Morgan, for example, sold its physical commodities business in 2014. Goldman Sachs reduced its commodities exposure. Deutsche Bank exited most commodity markets. This isn't about silver specifically. It's about all physical commodities. But silver is particularly affected because it's smaller and less liquid than markets like oil or gold. What does this mean in practice? It means there are fewer entities willing and able to act as intermediaries between the paper and physical markets. It means that if there's a surge in demand for physical delivery, there are fewer mechanisms to smoothly convert paper claims into actual metal. It means the market is less resilient to shocks. Additionally, there are reports, though difficult to verify completely, of specific restrictions on bank trading desks regarding silver. Some traders have alleged that internal risk management at banks limits their ability to take large physical silver positions or facilitate large deliveries. Again, this isn't a conspiracy. It's risk management and regulatory compliance. But the effect is the same: less flexibility in the physical market. Now, let's add another layer: central banks. Central banks hold massive gold reserves. The US holds over 8,000 tons of gold. Germany holds over 3,000 tons. These gold reserves are considered strategic assets. But central banks hold almost no silver. Why? Because silver was demonetized. After it was removed from coinage, central banks sold off most of their silver reserves. Today, central bank silver holdings are negligible. This means that if there's a monetary crisis or a loss of confidence in fiat currencies, central banks have gold to potentially back a currency or restore confidence. But they don't have silver. Silver is held by private investors, industrial users, and a few government stockpiles, but not by central banks as monetary reserves. This creates an interesting dynamic. Gold is still somewhat within the official monetary system through central bank reserves. Silver is completely outside the official system. It's purely a private market. This makes silver potentially more volatile and more sensitive to private investor demand. If individual investors lose faith in fiat currencies and turn to precious metals, silver could see more dramatic moves than gold, simply because there's no central bank or government entity that can stabilize the market by releasing reserves. Let's talk about another critical factor: the gold to silver ratio. Historically, throughout much of human history, the ratio of gold to silver prices hovered between 10 to 1 and 20 to 1, meaning 10 to 20 ounces of silver equaled the value of 1 ounce of gold. There were periods where it varied, but that was roughly the long-term average. This made sense based on the relative scarcity of the metals in the Earth's crust and the relative difficulty of mining them. In modern times, the gold to silver ratio has been much higher. In recent decades, it's around 60 to 1 or 70 to 1. During the March 2020 panic, the ratio briefly spiked to over 120 to 1. Currently, as of late 2024, the ratio is around 85 to 1. That means it takes 85 ounces of silver to equal the value of 1 ounce of gold. Why does this matter? Some analysts argue that silver is undervalued relative to gold. They look at the historical ratio and the current ratio and say silver should be much higher in price. Now, this argument has limitations. Historical ratios don't necessarily predict future prices. The modern economy uses gold and silver differently than ancient societies did. But it is a data point worth considering. If the gold to silver ratio were to revert to, say, 50 to 1 and gold stays at its current price around 2,000 per ounce, that would put silver at $40 per ounce. As of now, silver is trading around 24 per ounce. That would be a 67% increase. Again, this isn't a prediction. It's a mathematical observation about historical relationships and current valuations. Now, let's talk about supply and demand fundamentals going forward. On the demand side, industrial uses of silver are projected to grow significantly. The green energy transition requires massive amounts of silver. Each solar panel uses about 20 grams of silver. Global solar panel installations are increasing dramatically as countries try to reduce carbon emissions. Electric vehicles use more silver than traditional cars, up to 1 ounce per vehicle for wiring and electronics. The electronics industry continues to grow. 5G networks, artificial intelligence infrastructure, data centers, all of these require silver. Medical applications are expanding, especially silver's antimicrobial properties in wound dressings and medical devices. The Silver Institute, an industry group, projects that industrial demand for silver could increase by 15 to 20% over the next decade. On the supply side, silver mining is constrained. Most silver, about 70%, is actually a byproduct of mining other metals like copper, lead, and zinc. Only about 30% of silver comes from primary silver mines. This means that silver supply is somewhat inelastic. You can't just decide to mine more silver in response to higher prices. You'd have to increase copper or zinc mining, which is driven by demand for those metals, not silver. Additionally, existing silver mines are depleting, and new discoveries are rare. The quality of ore is declining, meaning miners have to process more rock to get the same amount of silver. This increases costs and environmental impact. There are also geopolitical considerations. Much of the world's silver comes from countries like Mexico, Peru, China, and Russia. Political instability, nationalization of resources, or export restrictions could tighten supply. The combination of rising industrial demand and constrained supply suggests that the physical silver market could tighten significantly in the coming years. This is not speculation. This is industry projections based on known trends. Now, let's bring this all together. You have a physical silver market that is relatively small with constrained supply and growing demand. You have a paper silver market that is vastly larger than the physical market with leverage ratios of 100 to 1 or more. You have banks facing restrictions and pulling back from physical commodity markets. You have a historical pattern where monetary expansion and currency debasement drive investors to tangible assets. You have current macroeconomic conditions with high debt levels, ongoing monetary expansion, and inflation concerns. And you have a complete disconnect between central bank policy, which holds gold but not silver, and private investor behavior, which increasingly demands physical precious metals. What are the implications? First, the price discovery mechanism in the silver market may be broken or at least distorted. The paper market sets the spot price, but that price may not reflect physical reality. If you can't actually buy silver at the spot price, is that really the price? This creates uncertainty and opportunity. Those who understand the disconnect can potentially benefit by acquiring physical silver at artificially suppressed paper prices. Second, there's a real risk of a delivery squeeze or market disruption. If even a small percentage of paper silver holders demand physical delivery, the system could be stressed. This wouldn't necessarily be the end of the world, but it could cause dramatic price spikes, delivery delays, and market dysfunction. History shows that when paper claims exceed physical assets by large margins, stress events happen. It's not if, it's when. Third, the role of silver as a monetary metal may be rediscovered. For the past 50 years, since silver was demonetized, it's been treated primarily as an industrial commodity. But if faith in fiat currencies continues to erode, if inflation remains persistently high, if there are currency crises or debt defaults, people may remember that silver was money for thousands of years. The monetary demand for silver could return, layered on top of industrial demand, creating a supply crunch. Fourth, the wealth preservation function of silver becomes more important. In every historical example we discussed, Rome, Weimar, Spain, the 1970s in the US, those who held tangible assets fared better than those who held paper currency or paper promises. This doesn't mean you should put all your money in silver. That would be foolish. Diversification is always key. But it does suggest that having some exposure to physical precious metals as part of a balanced portfolio is prudent. Fifth, there are geopolitical dimensions. Countries like China and Russia have been accumulating gold reserves while reducing their holdings of US Treasury bonds. If there's a move away from the dollar as the global reserve currency, precious metals become more important. Silver, being more affordable than gold for average citizens, could see significant retail demand internationally. Sixth, the industrial demand story is real and growing. Even if you don't buy the monetary argument, the simple supply and demand economics of silver for industrial uses suggests higher prices ahead. This makes silver both an inflation hedge and an industrial commodity play. So, what does all this mean for you practically? It means that silver deserves your attention. Not as a get-rich-quick scheme, not as a gamble, but as a serious component of understanding money, markets, and wealth preservation. Whether you choose to own physical silver or not is up to you, but understanding the dynamics we've discussed, the history, the market structure, the supply and demand, the monetary implications, that knowledge has value in itself. It means being skeptical of paper prices and understanding the difference between paper claims and physical ownership. It means recognizing patterns in history and seeing how they might apply today. It means thinking about what money really is, what gives it value, and what happens when trust in monetary systems erodes. I'm not here to tell you that the dollar is about to collapse or that silver is going to fuzz under $1,000 per ounce. I don't know the future. Nobody does. But I am telling you that the patterns we see today rhyme with patterns from history. And history teaches us that when paper currency is expanded beyond the real economy's ability to support it, when leverage in financial markets creates massive claims on limited physical assets, when banks face restrictions that reduce market flexibility, and when investors start questioning the value of paper promises, tangible assets become important. Rome didn't collapse overnight. The denarius was debased over 400 years. But eventually, the accumulated debasement destroyed the currency and weakened the empire. Weimar happened much faster, collapsing in just a few years. We don't know which timeline we're on, or if we're on either. But we can observe, we can learn, and we can prepare. Silver has been money for 5,000 years. It was only demonetized 50 years ago. In the grand scope of human history, that's a blink of an eye. The instinct to turn to silver and gold in times of monetary uncertainty is deep and proven. The current market structure, with its paper leverage and bank restrictions, creates conditions that are historically unusual and potentially unstable. Understanding all of this gives you perspective. Perspective allows you to make informed decisions. Informed decisions give you confidence, and confidence in uncertain times is invaluable. If this deep dive into silver, money, and history changed how you see the markets and the monetary system, hit that like button. Drop a comment and tell me which historical example resonated most with you. Was it Rome's slow debasement, Weimar's hyperinflation, or the disconnect between paper and physical markets today? I read every comment, and your insights often shape future videos. Subscribe to this channel because every single week we dive deep into economic patterns, historical cycles, and market mechanics that mainstream media completely ignores. Next week, I'm breaking down the exact mechanics of COMEX delivery, how it works when it fails, and what the warning signs are. You don't want to miss that. And if you want to go even deeper, check out our video on the history of gold, same patterns, different metal. The link is in the description. We also have a detailed breakdown of how ETFs actually work, allocated versus unallocated, and why it matters. Knowledge is power, and in a world of paper promises, understanding tangible truth is your greatest asset. I'll see you in the next one.